I was chatting to Michael Keenan of Standard Bank earlier this morning, and he was saying that the relative rand strength that we're seeing is more a case of a weaker dollar than as a result of a risk on trade actually coming to the fore just yet. Do you share that view?
Yes, I do. I think that at the moment we've got a lot of things that are still playing in the system, a lot of things that are concerning traders, specifically those with a view to put on a riskier trade. If you think of the fact that we've seen a week where the Italian issues on the peripheral Europe really reared their head on Monday and Tuesday, and slowly we've started to see those abate slightly. We're still looking for tomorrow as the big day. We've got Italian budget, constraints coming through. They are putting those forward. Hopefully that will create more calm in the market. You've got the Greek debt restructuring that they're looking at, and hopefully there will be some form of clarification around how they're potentially going to solve that issue, as well as the fact that there are the European bank stress tests. So the European zone still remaining a big concern for risky participants, as well as the uncertainty now with the US, particularly around the fact that Moody's has downgraded them from a AAA status. So I think that there's remaining uncertainty in the markets, specifically if you look at the fact that developed world remains under pressure. We've got retail sales out today. But I think in general, the market's kind of taken a bit of a breather, put a bit of a plaster on the wound. It hasn't gone away, but nonetheless, just some sort of dollar weaknesses that is playing through on the back of what Bernanke had to say yesterday.
Let's delve further into those comments out of the US, because we've simultaneously got slow progress being made with regards to agreement to raise America's debt limit, which needs to be done by August the 2nd. That or the government runs the risk of default. Is that, is it a case of as good as anyone's guess as to how things are going to progress here?
Well, look, at the moment it's extremely heated. I mean, Obama's just walked out of the meeting, not happy with what's been progressing this morning. And I think that what's happening is you're seeing a lot of tension between the government and obviously the central bank, as well as the federal officials, around how to manage this extremely uncertain scenario. I mean, if you look across the board, debt levels are extremely high. And unfortunately, what's happening is that repayment is coming back. If you look at Italy, one of the big drivers around the concern was the fact that they've got repayments that are coming due in August and in September. So, you've got this continued concern around how those are going to be met, what the likelihood of default is, and specifically around the fact that we're talking about sovereign default. It's a very, very significant issue.
With that, we've had gold safe haven status really, climbing top of the agenda. We've seen investors piling in and that gold price hitting a new record high. Let's look at, the role the rise in the commodity prices playing in at this stage of the game and helping cushion some of the losses we could potentially be seeing filtered through to the local unit itself.
Well, I think as a commodity-based currency, we're not necessarily performing some of the others. I mean, if you look at what's happened on the South Africa hasn't performed as well. Nonetheless, the gold. If you look at rand gold prices, we certainly, we're at higher levels. We're not at the all-time highs, but we certainly are at higher levels. So that offers opportunity to our mining producers, etc. More importantly, I think what you're starting to see is that safe haven of gold is just becoming more and more implemented. And what you saw recently was that move into the US assets purely as what we call a safe haven kind of move. My stab at that is really, are you buying US assets purely because there's no other appetite in the market, or is it because it really is in fact a risk-free asset?
Yeah. So where over the last 12 months, Brigid, I mean, the dollar rand's been trading between 650 and 725. For now, that type of range still seems to be intact for the large part. To what extent is this a channel at risk with all the global developments that are playing itself out?
Well, I think for now we're still seeing good support in our local markets. I think that the investors that we saw previously have got bigger fish to fry. I mean, if you think of a lot of the European counterparts that were involved in South African bonds, potentially still sitting with their positions but not putting more on book because of the huge peripheral issues that are presenting themselves in Europe at the moment. So from that perspective, really worrying about their book in terms of their European exposure, and that's not necessarily negative for South Africa, but what it really does show you is that that's where the real concern is. We had the Italian auction today, went relatively well, slightly better than what the bid to cover ratio was previously, but still I think the market was hoping to see a little bit more appetite at these current yields, and you're seeing that filter through into the euro. So I think for now we can and to remain between 670 and 7 levels whilst the market finds some form of direction, and ahead of the weekend and ahead of these extremely important meetings that hopefully give us some clarity around the extremely uncertain peripheral issues that remain.
Of course, as we've been highlighting all through this week, it's those global developments that are still front and center more than anything else in terms of influencing factors for the local unit. To what extent are you paying attention to the local noises out there where we've got strike action amongst the biggest threats to the economy at this stage?
Well, I think that that's one of the points that we've been raising for a while, is the concern around the effects of the wage negotiations that are putting inflation under pressure, and certainly second round effects. In an economy that's struggling anyway, and certainly in the global backdrop that we find ourselves, it seems a little bit politically driven, and therefore, it makes you wonder what the outcome's going to be and what the ramifications are in the South African economy in an extremely fragile global backdrop. So I think it'll be interesting to see next week at MPC what our MPC feel about the concerns, the risk factors that face us, especially now as food inflation is starting to peter off slightly, oil prices are a little bit more level. Is the comment going to be more dovish than we expect? And what do they see in terms of the risk factors, especially with the rand remaining range bound, therefore keeping us buffered? Your administered prices, your wage increases, those types of things are South Africa specific right now, and that's a big concern.
While we wait, for that MPC action on the local front, we've seen the strength of the yen again raising the spectre of a possible intervention by Japan following the coordinated move we saw from the G7 on March the 18th when the yen rose sharply. What are you anticipating in that regard?
I think for now they're probably going to remain on the back seat, purely just because we've Japan at the moment's under pressure. I don't think we'll see any central bank intervention because we haven't point. That being said, though, should there continue to be pressure, you may start to see some form of their central bank intervening. Whether or not we'll see the concerted effort we saw before remains unlikely at this point in time. But we did see some form of what we call quasi-central bank intervention, just to try to support the unit. But at the moment, like you say, remaining below that 80 level.